Hello there and welcome to the Look Ahead with me, Fiona Cincotta, Senior Market Analyst at City Index, and we will be looking ahead to the week which will be beginning the 17th of November. So without further ado, I will ask you to read the risk warning as always. I'm just going to put myself on mute whilst you do that. Okay, so let's, as we always do, just start with a quick recap of where we are, because it's been quite a volatile week, in fact. So if we just have a look at, or this is the S&P 500 that we're looking at here, we are looking at quite a sharp decline. We saw the recovery, if you remember last week, the share price, or the markets fell off quite sharply, dropping to a low there of 66.30 in the S&P 500, but it did spring back. In fact, it didn't close down that low, and then actually we saw we saw a recovery last week, across this week, sorry, to 68.77. That was a lower low from that record high. Then we've seen this really sharp sell-off over the past 2 days, which is really interesting because it's happened as the US as the US government has actually reopened. So the sell-off that we saw at the end of last week, that was to do with concerns over the health of the US government, the US economy. We saw the jobs market, challenger jobs cuts come in really weak there. But then actually what we've seen is the US government has opened this week. We've just literally had the bill passed through the House of Representatives on Wednesday, signed into law by Trump Wednesday evening. So government reopened on Thursday, and we saw that big sell-off. Now what's happening here is basically there have been a lot of concerns that even though the US government is back open, data may not necessarily be coming through as thick and as fast as the market was hoping and as the Fed was hoping. Government officials have suggested, in fact, that the October non-farm payroll report and inflation report may never be released at all. So what this may mean is that heading into the December FOMC meeting, which is on the 10th and 11th of December, the Federal Reserve may actually still be flying pretty blind. They may get some September non-farm payroll numbers in, but that might be it. So given that Federal Reserve Chair Jerome Powell was concerned over the lack of clarity in the outlook, he did note that in his press conference following the previous FOMC meeting. This does mean that the market is now actually thinking, hey, the Fed may not be cutting in December. And I think, you know, Federal Reserve Chair Jerome Powell in the press conference again was sort of warning that the market was maybe getting a little bit ahead of itself as far as that the December rate cut expectations were concerned. And, you know, we've had several Fed speakers this week who have also raised doubts over the likelihood of a Fed rate cut. And that does mean that the expectations for a Federal Reserve rate cut in the December meeting have fallen significantly. So this is the Fed Watch tool that I've brought up here. Let's have a look. It's now below 50%, okay, for a rate cut. And if we just have a look, you know, that was down quite considerably from 94% a month ago, and 94% a month ago, and 67% just a week ago. So we've seen a real sharp recalibration of Fed rate cut expectations, which has obviously pulled stocks sharply lower. So just have a look here. We've seen the S&P 500. This is trading within, I mean, it had been trading within this rising channel for some time. It'd been in a really solid uptrend since June, potentially even earlier. We have this divergent RSI, which was giving us a few warning signs, but we were just waiting for some further signals. And if we just have a look there, I think that candle there, one right at the top, let's home in on that. Yeah, there we go. We've got a shooting star there, which was the signal for the decline, the reversal. That's often considered a bearish reversal. We're taking out the support of the rising trend, lower band of the rising channel, taken out at the moment, and that's also the 50 SMA in there. Next level to be watching is going to be this low here. That was the November last week's low, which was 66.30. If we get a break below that, that's the forming of a lower low. So we'll have a lower high and a lower low, and it brings this level into focus at 6,500, which was the October low, to see how the markets potentially could react with that one. So interesting. I'm just going to pull up the Dow Jones, because the Dow Jones did actually reach a record high last week, this week, sorry, I say, there we go, up there at the record high. It has fallen off, but again, it hasn't fallen off as much as we've seen on the S&P 500, and that's because we've also been seeing this sell-off in tech stocks, which has weighed on the Nasdaq, which has underperformed this week, and also the S&P 500. Obviously, the Dow Jones also sold off, but that was after it had reached a record high, hasn't sold off as that deeply. Just going to have a quick look at what's going on with the dollar, because this is interesting, because despite the fact that we've seen US stocks falling, we haven't actually seen the US dollar increase, even though treasury yields have also been rising. So usually you'd expect the dollar to appreciate under those circumstances as well, but it hasn't. So, you know, and that's telling us that actually the markets are looking to alternative areas other than the US dollar, other than US equities. So we saw that rejection of the 200 SMA falling back lower. We've seen the prices still holding above the 50 SMA, but it found a low there at the 99 level. So it's just hovering between that 99 now and the 100 on the upside, which is also the 200 SMA. So that's what we'd need to get a move above in order to move forward. And just the last one that we're going to look at before I actually go into what's going on this week is just let's have a quick look at gold. Because again, gold had a really strong rally this week. It did reach up to that high, but again, if we have a look at that candle, a little bit ominous, that candle. I mean, gold was up at the time I looked earlier in the week, it was up 5%. So an absolute phenomenal week, even though the situation, even though the situation was actually clearing up as far as, you know, the ending of uncertainty of the US government shutdown. So despite that, we saw this gold price rally, and that's something to do with the weaker US dollar, something to do with the sell-off in equities. Although it's interesting if you have a look, because actually the days that gold rose were also the days that equities rose, and the days that gold's been selling off is the days that also we've seen the sell-off in US equities. So, you know, just having a look at those candles, though, they don't look terribly inviting for the bulls. You've got those long upper wicks suggesting that demand at those higher levels is not so strong. So if we just have a look here, this is the level we're watching for on the downside, 4,038. That's the rising trend line support. It's also a level that we found support resistance at there, and also in early October. A fall below that will bring this level here into focus, 3,880, and that's the low we saw back in October. So, you know, gold again just being affected by those expectations that actually the Federal Reserve may not cut interest rates as quickly as hoped, and obviously for non-yielding gold, a lower interest rate environment is more beneficial. So that is everything that's been really going on this week. We also saw some big moves in oil, but we'll come to that shortly. Just as far as data is concerned, so first up, we've got GDP figures from from Japan, expected to show a decrease 0.6% after rising 0.5%. Now, interestingly, the US dollar, Japanese yen has had a bit of a week as well, actually, last week. Actually, it rose to an almost 9-month high. And that was basically on expectations that the Bank of Japan may not be hiking interest rates anytime soon. There seemed to be sort of a request almost from the new Prime Minister, Senator Kaichi, for loose monetary policy. We've had sort of less hawkish stance from the BOJ, Governor Ueda, and that sort of, raised questions over whether they'll be hiking again in December, which is looking quite unlikely, as the market had expected. And as a result of this sort of expectations of looser monetary policy coupled with expectations of sort of, fiscal stimulus from the new Prime Minister, you've seen a really sharp weakening in the yen against the US dollar, even though the US dollar has fallen against its major peers this week. So we did reach that high of 155. We also had threats of or warnings from the finance minister in Japan suggesting, and when we do get warnings from the finance minister, it is sort of, raises concerns over intervention. So there are questions over whether the Bank of Japan will intervene. Do you remember we're sort of around those levels, 155, where we have seen previously interventions? Obviously, we're still some way off that sort of 59 high that we saw back in 2025. But the thing about interventions that we know is they're very expensive. So there's only so much intervening that the finance minister can do. But what's interesting here is you've got the slightly more dovish stance from the BOJ and that fiscal loosening from the government, which is adding to the weaker yen. If we get weak GDP data as well, then that could see this pair break out of this rising channel, break out above the 155, head towards that 156.60. That was the level that we saw back in November last year. And it's only above that then we start to look towards that 158 level, 158.88. That was the 2025 high. Stronger than expected data. Any fears of intervention could see the price sort of dip back down towards this 153.25 level. That was the high that we saw back at the beginning of October. And then below that 151 comes into focus there. So what else have we got? I'm just going to go stick a little bit with the US first before we come back to other points, because there's a little bit going on as far as the US is concerned. Even though we're still not 100% sure on when data is coming through, we do have the FOMC minutes. Now the FOMC minutes are they're from the meeting in September where the US Federal Reserve cut interest rates by 25 basis points as expected, taking rates to the upper level of 4%. Now, it wasn't a clear unanimous decision. We had Trump's appointee, Stephen Miron, voting for a larger 50 basis points cut, whilst Schmidt voted to leave rates unchanged. So even the vote split highlighted the divergence within the committee, and the minutes should provide more insight into these divisions, providing more colour on the likelihood of a December rate cut. Now, following the meeting, Powell did sort of, as I mentioned, warn the markets over getting too carried away about December rate cut expectations. And whilst the US government has reopened, as we said, the Fed continues to fly a bit blind, given the lack of official statistics from the BLS and on the economy. So, the minutes, as I said, should provide a bit more colour as to the potential timing of the next rate cut. The Fed good chance will want to hold steady, but until they actually get some data, rather than making two blind cuts. But the market has currently moved, as I said, expectations for a rate cut in December below 50%, which has helped this sell-off that we have seen today. this is the Nasdaq. We're just having a look at what levels have been breached here. Obviously, there's also those concerns about tech stocks coming in. But on the downside, we're just testing this level here. This was the low that we saw back in last week at the 24,600 level being tested. You got the RSI below 50, down below the 50 SMA, breaking out of that channel. Next level to look for will be the 24,000, which was the October low. Now, in addition to the Fed minutes, we've also got Nvidia will be reporting. This is the final of the Magnificent Seven to report, and it comes at the time when the market actually really needs some reassurance as far as the AI trade is concerned. There have obviously been a lot of there've obviously been a lot of concerns and questions over the level of AI spending that's been going on, the fact that it seems like quite a circular basis that we've been seeing. So it's the investment of one huge tech into another, into Nvidia and OpenAI, which has been building these profits. So yeah, the market just feels like it's getting a little bit uncomfortable with the way that it's been working. But this is Nvidia. I mean, if we have a look at what the share price has been up to, it's clearly still very much in an uptrend. I mean, there's no doubt about it. And I mean, if we just let me get rid of this one. There we go. So Nvidia's reporting on the 19th of November, and I mean, if we just think about what happened, this as far as the share price is concerned, we saw that following the Q2 numbers, the share price did actually push up to record highs of 212, which basically took the market cap over above the 4 trillion level. And the Q2, this was, numbers were impressive. Revenue came in ahead of forecast at 46.7 billion. Data center revenue was 41.1 billion. That was 6% higher than Q1 and 56% higher year on year. Also, interestingly, that was achieved with no H20 sales to China-based customers in the quarter because of restrictions that have been placed on it. Even in Q3, chipmaker is expecting Q3 revenue of 54 billion, give or take 2%, with margins set to increase by 1%. Data business, again, will be very much in focus, given that it's the core driver of the company. But companies are stating that 6,000 Blackwell server GPU is being adopted by big names such as Disney, Foxconn, and TSMC. So there's a lot to look out for. The thing is with Nvidia, when it reports, and this is something that we do see quite often with Nvidia, is when it reports, it sometimes initially falls before then pushing on higher. I'm not saying that that's what's going to happen this time, but it's often priced to perfection. And if there is anything in the report that could just even be a sniff wrong, then that's sort of, seen as a chance to book profits as far as the trade is concerned. So let's wait and see what they can do. Levels to be watching out for. There's quite a lot riding on this, I think, just as far as that AI story is concerned. We're testing the 50 SMA right now at 185, and you've also got the rising trend line support there. Below that 177 sort of feels like a level, and then if we get below this level here is where we're going to get sort of serious lower low, riding out, moving away from that sort of more longer term uptrend, and that's at the 165 level. So they're the levels to be watching in the near term. Obviously, if we find upbeat numbers, the mood improves, then obviously, and this support holds, then we'll be looking for a rise above 212 in order to get higher highs. Other thing to watch out for next week, just as far as the US is concerned, it's a big week for US retailers. You've got the likes of Walmart, Target, Home Depot, they're all set to update the market with their fingers. And given that lack of economic data, the numbers could provide further insight into the increase in the health of the, provide further insight into the health of the US consumer ahead of the key holiday season. Inflation's cooled, which could be helping, but there are a little bit of rumblings about the jobs market, which may hurt consumer confidence. In which case that may be starting to show up somewhere in retailers' numbers. So if it is going to show up somewhere, that's where it's going to be. This is the Dow Jones. Let's have a look. So the Dow Jones it ran into that record high, as I said, at 48,425 and has fallen lower, taking out this support here at the 48,000. Dropping next level to watch out for is the 47,000 support here, and then we've got the 50 SMA at the 46,500. So, you know, if we do get strong numbers, increasing risk appetite, and move back above the 48,000 and the 48,400 creates higher high. Otherwise, lower low, be looking for a break below this one here, which is the 46,500 figure. So next to watch, UK CPI. The pounds had a bit of a shocking week this week. So, I mean, UK CPI, the most recent Bank of England rate decision kept rates unchanged at that 4% level. And the vote was tighter than expected. Now, I think the reason that we saw a tight vote is because of the inflation figure for September, which only increased to 3.8%, up from only remained steady at 3.8% rather than rising to 4% as expected. So that sort of raised the expectations that actually we could be at a peak level as far as CPI is concerned. But I think the question here is, just because it's peaked, it doesn't mean it's necessarily going to come down quickly. And this is where we're sort of seeing the divergence within the Bank of England policymakers. So you've got Catherine Mann and Hugh Pill, they're sort of concerned about persistent inflationary pressures, whilst you've got others who are growing more concerned about seeing growing evidence that inflation will start to slow, especially given the weak growth. We had GDP at just 0.1% this quarter in Q3, 0% in September, and obviously the slight deterioration in the jobs market that we're seeing with unemployment rising to 5% and some signs of wage growth weakening. So cooler than expected inflation likely to boost the Bank of England rate cut expectations for December, which are now up at 80%, having been at zero literally just before the end of last month, before the Bank of England rate decision at the start of this month. So weak data, if we're going to see weaker than expected inflation, this is the level to be watching on the downside, 131. And then if we get a break below that, look at the 130 level. Below here, lower low, looking down for 127. Obviously, we've also got the budget coming into focus, which is on the 26th of November, where we're expecting fiscal tightening, which could in fact cool inflation further. So that would then help the Bank of England to cut interest rates further. On the upside, levels we're watching for 132. That was sort of the lows that we saw around July time. It seems to be the level that capped any recovery. And above here, then we'll be looking to 132.80, which is the 200 SMA. We've also got UK retail sales, which will be interesting to watch because UK retail sales, we did see the BRC sales came in weaker than expected in a sense that we're seeing some nervousness from households and consumers about what might be coming from the Chancellor. If we're going to see an increase in taxes and means reduced disposable income for households, then that could all be quite disruptive for household spending, which could mean that retail sales start to fall. This is the FTSE. It had briefly broken out of this rising channel that we've been trading in, fallen very sharply over the last two sessions as it drops towards, this is going to be the next level to be watching out for, which is the low that we saw of 96.40. That's also the high that we saw in early October, the low we saw in November. So that's where sellers could be aiming for with the most recent sell-off. That's where support's going to be sitting. A break below that creates a lower low, exposes the 50 SMA and the lower band of the rising channel at 94.88. So, and just a quick one before we end on the Eurozone, we've got PMI data. We've got PMI data for Europe, for the UK, for the US. So there are some figures. As far as PMIs are concerned, we did see some encouraging numbers for the PMIs in October. I think activity as measured by the composite PMI was around a 17-month high in the Eurozone, which is really encouraging. It's a sense that, you know, growth is potentially moving in the right direction, albeit very slowly. Now, the ECB will obviously be watching these figures, but the numbers are not likely to adjust. ECB outlooks, the central bank's got inflation around the 2% target level, so it's not expected to be cutting interest rates again at any time soon. In fact, it could well be at the end of its rate cutting cycle, which is what's supporting the euro, and the fact that they may be at the end of that rate cutting cycle does mean that the euro has some support. What we are finding is the recovery there has stalled. It's stalled around that 50 SMA exactly. So that's the level that buyers are going to need to want to get above. So if we get some encouraging PMI data, strong numbers, that could help the euro US dollar push above there towards the 117 level on the upside. On the downside, immediate support there, 115.40. That was the low that we saw in October. It's also a high that we saw back in April. And then below here, 114 comes into focus. Now, just another one we're going to have a quick look at is oil. We've had quite a lot of movement on oil. We've seen this week the OPEC report. They're sort of suggesting that actually there may not be a balanced surplus. No, sorry, that there may not be. They're moving away or moving towards expectations that actually there could be a supply glut this year, which they hadn't really supported up until now. So that was in their monthly report, which has unnerved the market. See that massive bearish that bear engulfing candle there that we saw on Tuesday. That was on Wednesday. That was following the report that we saw. Now we have seen prices attempt a little bit of a recovery today because of a drone attacks on Russian by Ukraine. Which has just raised some concerns over the supply situation, but not enough to get the market breaking out. Just as far as what we're looking at here technically, so I mean, oil prices are going to be in focus next week. Obviously, risk-off mood tends to weigh on oil prices. Concerned over the health of an economy could weigh on oil prices, and also the reined-in expectations of a Fed cut is also something we would expect to weigh on oil prices. Not oil trades within this falling channel. We do have a potential bull flag set up though, just coming up here. We just haven't managed to break out of the downward channel within that bull flag setup. We do need a move above 60.70 in order to attempt to break out, and that could open up towards 62.60 and then up to the 200 SMA of 64.50 level. But if we get a break below 58.30, that's going to invalidate the bull flag setup, opening the door towards 56 level. I hope you've enjoyed everything that we've talked about. It always goes so quickly, but I look forward to seeing you next week.